Okay, welcome to the second session of the DePaul University Capstone Case Study course for the Financial Planning Certificate Program. I'm Howard Sorkin, your instructor. If you have not already scheduled your 10 to 15 minute personal appointment with me to discuss your progress and what we're doing, and so I can answer some of your questions personally, it is your responsibility and part of your class assignment for you to do that. So please either email me or phone me to set that up. I don't care if you want to meet in person or if you want to do it over the phone. We'll work out whatever your needs are, but the purpose of this is so I can help you. Welcome, Susan. One of the issues that we have had in the past semesters is people don't realize how much work is involved in this case study course. We've actually cut down some of the homework assignments and some of the projects so that you can have more opportunity to work on the Harris case, and you can spend more time doing what you need to do as opposed to just the homework need to do for the course. I have been somewhat liberal in letting people extend the deadline as long as they're working on it and they communicate with me. So my goal is to help you get where you need to be. So again, if you don't follow up, you're missing out and it's part of your grade. Just so you know, we will be going over all of the online discussions and the answers to the homework, and hopefully, I believe by Friday you will have your comments and they will all have been reviewed. I don't know if there's any questions anybody wants to bring up, but this is your opportunity. Anybody? Okay, a couple things I want to reiterate then, if I might. Number one, they are changing the way the comprehensive exam is going to be administered. The next exam in July, well, because you're obviously not going to make the March exam. The next exam in July will be the last paper and pencil exam that'll be 10 hours over a day and a half. After that, did I lose the video here? I don't know.
Yeah, you lost the video.
I think my video, I just lost it. I don't know what's going on. Can you people tell me, give me a check mark or something if you can hear me? I'm more concerned with whether you can hear me than see me at this moment. Can I be heard? Hello, people. Am I there? I don't know what's going on here. So again, they're changing the exam, and you actually can go to the CFP board, and I'm going to try to get some links for you to put up, or what I'm going to do is try to get some test questions that they've released to show you the kind of questions you're going to be getting on the new exam. A lot of you indicated that you want to try and take the comprehensive exam in July, so I'm just trying to help you out. It's your decision. Either way, I would strongly encourage you to take a review course, especially if you're one of the couple people that are challenging the exam, so you have a better understanding of what they're looking for. It's not just as cut and dry as this subject and that subject. They want you to synthesize material, think as a financial planner, and so forth. Tonight I want to have a discussion about what you completed with the Beto case, and I have some questions for you, and that'll probably take a half hour to 45 minutes. Then I want to have a quick overview of some of the cash flow information, and I did put up, or will have up, and will stay online, the actual PowerPoint from Chapter 3, which deals with the cash flow statements, and there's some comments I want to make about that. At the back of your textbook, there are 12 or 13 case study samples. Each of them builds on the one before it in terms of giving you information so that you might have a better understanding of what to do with your comprehensive case study project. So one will be more. Am I here? Can you hear me? All of a sudden my screen went blank. It just came on again.
I can hear you.
Yeah.
Okay, fine. So as I was saying, that each of these case studies is geared a little bit differently. One will be on insurance, one will be on investments, one will be on estate planning. So each one, if you look at it, you need some help for that area, look at it. The one I want to make sure that we will discuss is the good and the good going bad on page 847, number 13, which is on ethical situations as a planner. Why do I want to discuss that with you? Because the comprehensive exam has been asking lots of questions on ethical situations as a planner, not just on what might be black and white issues, but how are you going to relate if something comes up. So my goal in this case study class is to make sure I cover a lot of the bases. That means you have a lot of work to do, because even if we were meeting every week for 3 hours, there's no way I could cover this entire workbook. And a lot of it is if you've taken the other classes, we're regurgitating a lot of information. If you're challenging the exam, it's assumed you already know this. So I'm trying to give you as much help as I can. So before we get into the Beetle case, are there any questions? Okay. When you looked over the Beetle case, and most of you did do the homework, we know we have Tyler and Mia, and it's their first marriage. And one of the things that's interesting in this case is it says Mia's close high school friend Brenda died of a sudden heart attack. That was the tipping point, or what forced her to think about financial planning, her future, and security for herself and her family, and especially her daughter. So that's not unusual as a planner, and many of you who are in the industry know that. There's something that tends to force us into action. I'm not going to read everything about the Beetle case. You've done that, I hope. It talks about the fact that they have one child and they're not planning on having another. Well, I have a question. Is there a guarantee they won't have another? I mean, is it possible that even if they don't plan on another one, they could have another one? Absolutely. So as you're building your case and your plan, you may want to even think about, and I'm not saying you should or shouldn't, but you may want to think about the what-ifs of having some extra money set aside. What if they need to have some extra money in their emergency fund and so forth? When we're talking about their net worth, when you're talking about funding Becky's college education, they're saying that they've determined they need $10,000 per semester, including room and board. Well, depending on where you live in the country and what school you may want to go to, that may be low. It probably isn't high. And also, remember, factor in a growth rate or an inflation rate for education that's higher than what they're saying is a standard inflation rate of 2 or 3%. You may want to use 6, you may want to use 7, whatever you're using in your work, especially when you're doing your case study, the Harris case. Make sure you identify what is your inflation factor just for education. Because in the Harris case, by the way, give me a check mark or raise your hand. I would like to know how many of you have even looked at the Harris case. Because that's the case you're building your case study on. And I want to be real clear. I had a student a couple semesters ago who did everything on the Beetle case and said, okay, here's my plan. And I couldn't accept it. And that student got very, very upset, saying I've spent hours doing this. And I said, you didn't read the syllabus. So it looks like none of you have looked at the Harris case. Please,
I read the case.
Okay, please take some time and think about what we need to do. So if on the Harris case, if you are looking at it, again, you may want to footnote or put in your information, we are assuming a inflation rate of 6, 7, 8% because educational costs tend to go up greater than the normal inflation rate. It says that Becky does enjoy her career as a counselor. I'm sorry, Mia enjoys her career as a counselor, not Becky, obviously, and that she has taken a part-time job. Tyler is valued by his employer, and his job requires some travel as a golf pro executive. Then, if you notice, and this is deliberate the way the case is structured in the textbook, if you notice, it has somebody earning money biweekly, somebody earning monthly income monthly, and then they're giving you a bonus, semi-annually. That's deliberate to make sure you're doing the reading and doing the math correctly. And it will not be unlike, it probably would happen on a comprehensive exam. They might structure it that way because they do want to mess up your mind a little bit. When you're doing the homework assignment, it says state and local withholding. It looks like to be it's about 6% for income taxes. Just so you have an idea of where that's coming from, it is about 6%. It says both Tyler and me are allowed to invest in a limited number of mutual funds within their 401k plan. Well, is this the best way for them to do things within planning for retirement? When you're thinking about that, it also talks about the match. Well, you want to make sure that they take advantage of the match, but might there be another way that they could put away money? Should you bring up a Roth 401k or a Roth of anything? Which is the most expedient way for them to put this together? I'm going to go over a little later about the cash flow statement. Many of us in the program have not done cash flow statements, and it does become a little intimidating, but be aware of the fact that it's something you're going to need to do for your project. They're not going to expect you to do an entire cash flow statement on a comprehensive exam. You don't have time. You have 2 to 3 minutes per question. But they might ask specifically what would be on the cash flow statement versus the statement of financial position versus a your budget. They might ask, what about disposable income? What about charitable contributions? On the exam, they may focus just on one item, and I want you to be aware of it. Again, on this sample cash flow statement on page 38 of the workbook, you'll notice it has items annually, quarterly, monthly, semi-annually, and again, that's just to mess up your mind, because obviously they could have converted things any way they wanted to with another column on an Excel spreadsheet. If I'm going too fast, please let me know. It says that they've attempted to calculate their liabilities, but they were unable to determine payoff values. Okay, well, if you remember, under liabilities, you need the total amount. On your cash flow statement, you need what you're spending every month. I'm flipping over a little more to their mortgage and whether it makes sense to refinance. Talking about insurance, it says they've also concerned about the negative outcomes associated with dramatic events like death or disability. That's giving you a hint that as part of your financial plan, if the Beto case was what you were looking at, you should make sure you include death, disability. But you might also want to look a little deeper, even though it's not mentioned because they're young. You might also want to be talking about long-term care needs. When we're talking about health insurance, use the health insurance plans that are in the book. And here they're talking about premiums where they're not getting into the Affordable Care Act. I have tried to check with other colleagues and some people I know at different institutions, and to the best of my knowledge right now, they're not even bringing up the Affordable Care Act. So if you're taking an exam in July or in November, please be aware of the fact you may want to ask a review instructor or send a note to the CFP board if you're not even taking a review class to find out if they're going to be covering that. I don't have the answer. If I did, I would give it to you. Under health insurance, they are talking about a Section 125 funding vehicle for health insurance. What does that really mean? If you get that as something on your case study with the Harrises, it would probably be a good idea to footnote and say, you have this plan, it means X, Y, and Z. There's nothing wrong, and it's encouraged cash flow statements, statement of financial position, estate planning situations, do use footnotes. It says is a positive that they're automatically covered by disability by the employer, and it says Mia also pays for an additional long-term disability coverage through her employer. So they both have something, and one has some optional additional benefits. Do they have enough life insurance? Now, I've said many times before in my introductory class, I'm not here to sell anybody insurance, nor am I here to say what is the best kind of insurance. But I am saying as a financial planning risk management tool, insurance, whether it's homeowners, auto, umbrella liability, health, disability, long-term care, life insurance, annuities, these are all tools we use to help us with risk management. I'm not saying you should learn how to sell insurance, but that's not the issue. But here's a question. When you're doing your analysis with a young child that they want to send to college, it looks to me as though Tyler has $100,000 whole life, and Tyler has 1 times his salary as group term. Mia has $100,000 whole life. She has 4 times her salary as group term. What does this mean when they put these numbers? Do you all understand what Section 79 is and how that has to be computed? We're going to discuss that a little bit later. But here's a way of seeing if you know that benefit pro thing, if you understand the tax ramification. This is the kind of thing that they're going to expect you to understand. Investment planning, it says that you're going to do a risk tolerance questionnaire to make sure that they're at least in balance with their risk tolerance and the way they're investing. And in the real world, I'll tell you, many times I've seen the female partner much more aggressive on investments than the man in the relationship. It says they want to retire at age 62. It also says earlier that they want to provide a good chunk of money for their daughter's education. Are they both realistic goals? Are they saving enough money for retirement? What about health insurance pre-Medicare? Because currently Medicare doesn't go down to age 62. These are all things you have to consider as part of the plan. It further says that Mia has a hobby that she'd like to turn into a business and open a small art gallery in her hometown. But she has really no idea what it's going to cost. They're throwing in here that she thinks it's going to be $80,000 if she opened it today. They're not saving any specific money for it. Is this a realistic goal? Is this a hobby? Is it something that she can rely on for income? Is it going to take away from her ability to retire at age 62 or enhance it? Again, these are all kinds of questions that you should be thinking about. They have wills that they created a couple years ago. It says that they used a self-help will kit, that they didn't necessarily go to a professional attorney advisor. Did they cover all the bases? It doesn't say whether they have a durable power of attorney for health care or for property. Is that important? And if so, why? Again, I'm raising this because when you do the Harris case, you're going to have to bring these things up, possibly. It says that Mia's older sister, who is single and lives in Oregon, which is not that close to the state of Missouri, will be named the guardian. Is that a realistic and a smart thing to have a single person who obviously has no knowledge of kids, especially if they're teenagers, what to do? Is she single probably because she doesn't want to be married and have a family? Is having your guardian 2,500 miles away realistic? Does that mean that Becky might be uprooted if there's an emergency? They want to make sure that they don't pay unnecessary estate taxes. Do they have an estate tax situation? Have they covered all the bases to avoid probate? And again, when you're taking the comprehensive exam, it's a national exam, so you don't have to get bogged down with your own state situation, but you may have to raise certain questions. If they're talking about a divorce situation, this case is not mentioning it, but I'm just bringing it up. They're probably not going to give you a divorce in a community property state unless they mention it's a community property state or say you're getting divorced in California and you should know it's a community property state. That also raises the question, what is the difference between a community property state and a non-community property state? That would be a tax question, an estate planning question, possibly the need for a premarital or postmarital decree. All these kind of things are included and should be included in your thought process when you're looking at a financial planning situation. They're broken down, and I'm going to go into more detail about their different investments in their different funds and cash equivalents. I have a question. Do you all understand cash and cash equivalents, and do you understand the need for emergency funds? If you don't, please make sure you do, and we're going to discuss that a little bit tonight. It says that their number one goal on page 48 is to retire at 62, and the number two goal is for them to have paid for 100% of their daughter's college education. That's their priorities. Again, is that realistic? Do they have enough cash reserves? It says they're comfortable assuming a yield of 3% before taxes on their savings. Is assuming that yield can help them get their goal? Do they have to goose up their return on investment? They don't want to pay off their car loan at this time. They're always anticipating they're going to have some kind of a car loan or auto loan. Their mortgage refinancing, it says that they will incur the mortgage refinance will incur 3% of the mortgage as a closing cost. Well, a lot of us are hearing the advertisements that you can do it for no money down. Many times be aware of the fact that your clients are going to come to you and say no money down, but then they find out it's a hidden charge on the back end. The home is expected to appreciate. Based upon what happened from 2006 to 2013, can we guarantee homes appreciate? Do homes all appreciate around the country at the same level, at the same rate? It identifies here in the body of the information that there's a 5% state income tax. That's a good thing that they're identifying, so when you do the case, you know to build in the state income tax along with the federal tax. So what this also will tell you is, or should tell you is, if there is a state income tax level and you're doing a comprehensive exam and that case study on the exam, they should be giving you that information. It talks here about disability and long-term care insurance. I was very pleased that in some of the comments I looked at on the case, one of your colleagues mentioned having the need to help family members with special needs situations and the need to help family members with long-term care situations. That is something that is increasingly important as a planner to help build into the plan, and quite frankly, in the Harris case, there's a question about something that you have to be aware of. I don't want to get into too much detail because I don't want to give it away. What happens with premature death? Do they have enough assets, both through the insurance industry and not the insurance policies, to pay for their living expenses? And don't forget, when you do your case, and you're talking about living expenses for minor children, there is a benefit for Social Security as a child survivor benefit that they're entitled to. In the event either Tyler or Mia's death prematurely, they all want their liabilities, including their mortgages, to be paid off. Well, if that's one of their priorities, do they have enough assets to do that? That's something you really have to look at. They're telling you about Social Security. Social Security is a huge, major issue today for most people. It is the kind of issue that people are looking at and they don't fully understand. They don't understand about what happens if you're divorced and you don't marry before the age of 60. Is there a benefit for that divorced former spouse based upon the former spouse's income? Well, if you're married more than 10 years, the answer is yes. And again, you can have more than one divorced spouse collecting that benefit at the same time. People don't understand what the maximum Social Security benefit is. They don't understand about how much income you are taxed on. They certainly don't understand that even if you're in a 401k or 403b, you're still paying FICA tax and Medicare tax on that money, but the income tax is what is tax-free. They further don't fully understand what the meaning is of Social Security benefits and what it means if you start taking it at 62, 65, 67. What's your full retirement age? What if you delay until age 70? How much more is that worth? What's the haircut before your full retirement age per year? What is the advantage to taking it before your full retirement age, if at all? Now, why am I saying that? In the last 2 weeks, I've been invited. If you notice, I have gray hair, and I have been invited to five learn about, ask about, find out about Social Security seminars. It's a big topic. It's being discussed all the time. It's a confusing topic. People don't understand it. So here, they're giving you numbers to play around with for Social Security, which should help you. On page 52, they're saying that Mia wants to build a small addition to their home with art. She wants to have this art studio, art gallery later on that'll cost $80,000. She wants to be able to get more art. It says they're going to need approximately 85% of their current earned before income tax dollars when they retire. Based upon what they're doing today, is that realistic? That's something you have to bring up. They're willing to reallocate their assets. They're willing to, it says they're going to assume a 25% federal marginal tax bracket. It tells you what their normal retirement age. In the Social Security world, that's called full retirement age. And be aware of the difference between full retirement age and what happens if you start prior to, or if you wait till age 70. What's it worth to wait? These are all the kind of questions you need to be asking. Then it also talks about some estate planning issues. They obviously don't have a federal estate planning tax issue, but they do have some issues that have to be discussed. Now, I'm going to take a deep breath, and I'm looking for my glass of water, and then I'm asking the following question. If you have the ability to discuss this with a microphone, fine. If not, you can use your chat box, and I will report back. But I'd like to spend 10, maybe 15 minutes, and let's talk about their strengths and weaknesses, what unique things you see, what you want to make sure you cover. Are there questions you have about this Beetle case? Are there things that, from your personal background, that you would enhance or be able to give them more suggestions on what to do? So I'm taking like a 1-second break to get my glass of water, and you think about that, and then we're going to come back and we're going to have a discussion. Sorry about that. I thought I brought my water with me. Okay. So the question is, most of you did the homework that are online. What are their strengths? Anybody? Don't be shy. Can you hear me? Is anybody here?
I'm here. Hold on a second.
Anyone in the room? Zach, go ahead. Zach, go ahead.
I'm pulling up my Excel sheet real quick to look at the strengths and weaknesses.
Hello? Okay. They're both contributing to their employer 401k to the level of the, at least to the level of the match or an excess. That is definitely a strength. I'm also looking to make sure that we understand what their other strengths are in relation to their two primary goals. Goal number one, which is to make sure that they want to retire around age 62. Goal number two is they want to provide 100% of their daughter's education. So what other strengths can we have here? If you can't use your microphone, enter the chat room.
They're saving a good amount each month. It's about $12,000 per year, but it's not directed at any specific goal.
Okay, so they're saving about $12,000. Zach, is that in addition to the money they put into their 401k, or is that part of the 401k money?
That is the mutual funds outside of the 401k and the annuity savings, the conservative annuity.
Okay, now the question with the annuity, are there any restrictions to being able to use the cash with that annuity?
Yeah, you can't. I mean, that would be more along the lines for retirement capital, because you can't touch it until 59.
That's correct. Well, you can touch it prior to age 59 and a half, but there will be an income tax penalty in addition to having to pay ordinary income tax on all the money. So you're correct. The annuity is more for retirement and has a few negative aspects, but at least they're saving money for retirement. Good point. Anybody else want to join us?
They have a pretty strong current ratio at about 5 to 1. So they're able to pay off their current liabilities very easily.
Okay, thank you. Anybody else? Okay, what about a couple negatives? Based upon their goals and their objectives, where do you see some negatives?
Well, they have negative cash flow per month. That's what I have calculated.
Okay, if they have a negative cash flow, how can they correct that?
You're going to work through their, discretionary expenses and see which things you can cut or which things they're spending too much money on, or reallocate some funds that way. But I have about $16,000 per year in a negative cash flow based on my calculations after discretionary expenses.
Anybody? Okay, does anybody else show a negative cash flow of $8,000 or something like that, if you've done it? See, because one of the issues is they're saving by one hand. Go ahead.
Oh no, I was just going to say I got a negative. Yeah, I got a negative cash flow too when I calculated it.
Okay.
And that was
See, that's one of the interesting things, right? They're showing a negative cash flow but a positive savings rate. Anybody find that a little strange?
No, I mean, it happens sometimes.
Well, okay, let me ask you, how do they do that?
They don't realize they've never done cash flow analysis of their own money. That's what I would guess.
Okay, but my question is, what I'm really asking is, if they are... Go ahead, Danielle.
Oh no, I was going to say maybe it's like their cash flow is negative. I know I think they had some credit card debt, so maybe they're putting, I don't know, some other expenses on there.
See, you have $3, $5, $7, $10, $30,000 in credit card debt, and you're trying to save money for retirement or for education for your child or whatever, and your credit card debt is at 8, 10, 12, 20%, what's the smartest thing to possibly do? Is it smarter to try to pay off your mortgage faster, put more money into savings, or try to pay down your credit card debt? And okay, these are things that you have to help analyze and discuss. The other question I have is, they're saving money, which is a positive, but they have a negative cash flow, so where are they getting that extra money to save? According to Zach, they have an $8,000 negative cash flow. Where's that money coming from? Are they saving money on the left hand and taking it out on the right hand to pay down so that they end up with less? Are they adding to their debt structure on their credit cards? Where are we coming up with this negative amount?
I have $16,000.
Again, this is only for discussion right now.
$16,834 negative cash flow.
I think that's Susan. could they be paying themselves first before paying off their credit card debt? They probably are. But okay, you're saying 16,000 negative cash flow.
Most of it's from
What
contributions.
they're really doing, I think, is they're using the bonus when it comes in to help fund whatever they need to fund. Now, paying themselves first is a great thing, and you should encourage your clients to do it. But if they have a lot of, I'm sorry, speak up. Who was speaking before? Was it Zach or Brad?
Contributions are
Hello?
the main. Yeah, I was trying. Their main costs are the. Hello.
I'm here. I'm listening. Hello? I can hear you.
You can hear me? Okay. The main costs are their charitable contributions per year,
Hello?
and that's costing them
Hello?
about $16,800. You hear me?
I can hear you. And Danielle can hear you.
Okay.
I'm assuming everybody else
Can you hear me now?
can hear you.
Okay. The main costs are the contributions to religious charitable organizations. That's $16,000 per year.
But now I don't hear you. Try it again, Zach.
The main costs that they have that are creating that negative cash flow are contributions to religious and charitable organizations. It's $16,800, and then their credit card debt, which is $5,100 per year. That's $21,000 right there in cash flows.
Okay.
Cash flows.
So as a planner, you may have to suggest to them that somewhere they have to modify their behavior because they can't keep doing what they're doing and expect to A, reach their goals, and B, the credit card debt is eating up a lot of interest, and as much as you want to be charitably inclined, you really have to think long-term about what you can do for yourself, correct?
Correct.
Am I being heard? Am I being heard? Testing, testing. I'm not sure you're seeing me, but I want to know if I'm being heard.
I can hear you.
Hello?
It's yes. Yes.
Hello? Okay. I keep fading in and out, and I'm right in front of my computer, and my computer is fully charged. Okay. Well, I just want to, what I want to do is, all I'm trying to do is open up some lines here of discussion so when you do the Harris case, look at things a little differently. You know, feel free to challenge people. Say, well, it's a great idea that you're saving an extra $8,000, but it's not such a good idea that you are spending, you know, so much money where you don't have enough extra, where you really have a negative cash flow. And it's very easy for people to have negative cash flow and say they're doing everything right. Anybody else want to add anything to what we're discussing here? Anybody? Okay, I'm going to put up some of the content for the financial statements because I do want to cover this because it's something that we sort of cover in the first class and really don't get back to it. I'm not going to go through all 50 slides. If you want to look at them yourself, number one, it's directly out of your textbook. Number two, I'm going to have the slides. They should be on tonight's lecture as well as additional content. Financial situation analysis. It's to help the client to achieve their goals. That's what it's for. It's not just an exercise to waste your time. When we're looking at financial situation, we're looking at the client situation in terms of their goals and their objectives. And as we had a discussion just now, they, on one hand, as I said, they had positive, good things for putting away money, but if you delve into it, it was a little negative. Analyzing their position will help them figure out if their goals are reasonable and if they can do it. When they talk about budgeting, most people in this country don't live on any kind of a budget. Most people in this country spend more than they have. I've said many times, according to research I've done, that most families are 3 to 4 paychecks away from financial ruin because they don't have any emergency situation. I would like to ask a question. Is everybody still in the classroom? There were five of you in the classroom a minute ago. Just give me some indication with a check mark so I know you're still here. Okay. Thank you, Brad. Thank you, Danielle. Thanks, Susan. Okay, because all of a sudden I couldn't tell. Zach, are you still around? Okay, I think so. Now, budgets should not be so confining or restrictive so that they say that you don't have some flexibility. When I would ask my wife when she'd take our daughter shopping, I didn't care how much she spent for a sweater or a skirt or a pair of jeans. I just want to know what do you spend on clothes, you know. And one of the things people get bogged down on when they're taking an exam is they try to go into every little nitty-gritty thing. Budgets should be a guideline, but they should be somewhat flexible, and they should be able to give you an idea of where you're going. Cash flow planning. Oops, let me get to the right slide here. Cash flow planning is just that. It's a guideline and again, do you have enough assets to help you do what you need to do? And I'm just highlighting this because this is going to be online so you can look at it. It's going to help you with figuring out your net worth or statement of financial position, and it's going to help you figure out a lot of other things. Obviously, you have to go through the goals and objectives. It says in general 1 or 2 12-month statement alternatives can be used. So when you're doing your financial plan, your case study for your course, you can say, here is your current cash flow statement. If you don't have the extra surplus income we can invest, maybe we can do this or maybe we can do that. Just so you know, as part of the financial planning process, when you're doing your plan and you're talking about it, you're supposed to have alternatives just to make sure that in case somebody wants something else, you have the ability to do that. An annual income statement calculates income from the client, and it says it includes all earned, unearned, taxable, non-taxable. One of the things people forget when they're doing cash flow statement is they only focus on income. Here's a question. Either send me some text messages or speak up. What are some other kinds of income to use in addition to your salary? Alimony, good point. I'd also put child support. And please remember, if you get alimony and or child support, you have to look into who has to pay the tax on it, if there is any, and how it's taxed. Interest income. Where could interest income come from? It could come from savings accounts, money market accounts,
Business income.
Anybody else?
Business income.
I'm sorry? Business income, capital gains, and be aware of the fact that you're not expected to be doing CPA work, but you do need to know the difference between the different kind of taxes. Income tax, state income tax, capital gains, gift tax, estate tax, so be aware of that. Okay, And notice at the bottom here, it says, remember that for tax purposes, the client can claim only $3,000 of capital losses in excess of capital gains. And what you're probably going to have to also remember for capital losses and capital gains is currently it's passive against passive, active against active. I mentioned earlier when we were talking about the Beto case, the Section 79 situation. What is that really going to mean? Now, what many people don't remember is that Section 79 is a section of the Internal Revenue Code that discusses employee benefits and employee life insurance and the amounts. You might know that the first $50,000 of group or employer-funded life insurance from all sources is received income tax-free and benefit tax-free to all participants. And it might be aware of the fact that from anything over $50,000 is subject to federal income tax. What people don't realize is that's called Section 79. And so if you get a test question where it just focuses on Section 79, I want you to be aware of what that is. It further says that there's a way to calculate that taxable amount. So this slide shows a chart. And this chart, if it is going to be on your exam, they will probably give you a chart. And this says if you are, as an example, between the ages of 30 and 34, it's going to cost you 8 cents per month per thousand for additional life insurance. And I'm going to get to where we're coming to in a moment. So here's where they're going to have the chart. Now, the next slide has an example, and you can compute this on your Beto case and or on the Harris case when you get there. It says, assume the client's 42 earns $80,000 per year, is insured twice for her annual salary. Again, the Beto case. There's $160,000 of death benefit. The client may receive $50,000 in covered tax-free benefit. Well, the client has $160,000. That means they have $110,000, and they're getting $50,000 of it income tax-free. That means they have $110,000 of additional benefit. The law says if you get that as a benefit, as a death benefit, it's subject to ordinary income tax because it's a benefit you didn't pay tax on. So therefore, they're going to increase your reportable income using the table that's called a Table I, using this table of saying how much the death benefit per month per thousand is worth. So in this case, she's 42 years old, so it's 10 cents per month per thousand times 110. That's how they came out to 132,000. Now, here's the situation. If you look back at this table, what you see is as you get older, it gets more expensive. And understand, this estimate is really low because in the regular table, I believe when you're over 70, it's like $15 a thousand or something. So what this is showing is as you get older, the amount of insurance you have that's taxable might stay the same, but then the cost is going to go higher. Today in many plans, after you're 65, if you're still working, that death benefit is cut in half. Please take a few minutes and make sure you're familiar with Section 79 rules and that you're going to be taxed on the benefit. If you don't pay tax on the benefit and the death benefit has to be paid, that $110,000 is ordinary income tax to your family. Well, let's say you're in a 30% ordinary income tax bracket and a 5% income tax bracket for your state. Well, right there is something around $45,000 of that benefit that you're going to have to pay in taxes because you didn't pay the Section 79 fee. Does everybody see how that works? It's very important you do because I know for a fact this was recently tested on a comprehensive exam. So I'm going to take a deep breath, and it says all Section 79 income should also be shown as an expense, and it's imputed income, even though it's not available to the client. And what people are going to find out under the current American Affordability Health Care Act is After 2018, if they have a Cadillac plan, that's going to come under Section 79 income also. Or actually, it may just be taxed as ordinary income. But that won't be on your test yet. Does anyone need me to go over Section 79 in any more detail so you understand it? Because it's tested. Give me an X if you're okay. Give me a check mark if you're not. Please. Okay, one check mark. Can you give me a hint of what you need me to cover? Because if you're brave enough and tell me you don't fully understand it, I'm sure somebody else doesn't either. Either send me a text message or speak up, please.
I'm all good on the calculation.
Okay. One person's good, one person's not. Oh, sorry. There was a correction. So 2 people are good on it. 3 people are good on it. Okay, if you're confused or need more clarification, send me an email and we'll do it privately because the people online seem to understand it. I'm not going to go through these slides at this moment. These are from the financial facilitator Excel spreadsheet that you're able to work on for your homework and your case study. It's basically showing where you would put things. I'm going to somebody raising a hand here. Okay, I want to flip down here. Dedicated expenses. Now, I will tell you, I personally have a problem with when I'm doing this myself, between fixed expenses and non-fixed expenses, because in today's world, a lot of things that used to be discretionary have become fixed expenses. Let me give you an example. They used to say, well, you need 1 tank of gas for $25, and now maybe you need 3 tanks of gas because you're driving more and you don't really understand where it keeps changing. Or it wasn't that long ago that you had milk at $5 a gallon. So when you're looking at discretionary expenses versus fixed or dedicated, be aware you understand what you mean, and you may need to use footnotes so you understand it. It says here, when developing the statement, income and expense statement, it's important to enter reinvested interest and so forth as reinvested. It's further, if you have a qualified account, you may have to list it separately. Again, this is right out of the textbook. Discretionary expenses are variable outlays that a client can control more easily. Okay, well, let me ask you this question. Variable expenses and discretionary. Do you need a cell phone with data information and texting in international services? I don't know. Do you? Can you get rid of your cable? What can you cut if you really need to cut? That's where you'd consider discretionary. Net worth. Very important calculation, the case study and the comprehensive exam. Assets minus liabilities equal net worth. It might be called a net worth statement on the exam. It might be called a statement of financial position. It might be called a personal balance sheet. Be aware that you have to understand what it is. Okay, I'm going to skip these slides because you can barely read them. Financial assets are loosely defined as anything that may be spent or invested. Now, use assets, and here's where there's a problem. Use assets would be to support your lifestyle. But sometimes use assets can also be a financial asset. When you take the comprehensive exam, and if you were in my introductory course, we talked about an art being an invested asset, art being a use asset, because you had to think of what was the intent. If I have art on loan at a museum, is probably an investment asset. If I have art, invested asset. If I have art hanging in my living room, it might be classified as a used asset. So you have to read the question carefully. And I can't give you a specific answer one way or the other because I don't know what they're going to be looking for on the test question. When you do that statement of financial position, if this was me doing it, I would show cash and cash equivalents. That's liquid money. Does everyone know, cash and cash equivalents are things that can be are in cash or converted to cash with no debt and relatively easily. And if we're talking about cash equivalents, those are CDs of less than 90 days maturity. Investments, again, you may want to even break it down between his, hers, joint. Retirement funds, I typically on my statements of financial position break down Jack and Jill's retirement account. Sometimes I'll have it as the 401k Jack, IRAs Jack, Roth IRAs, Roth 401ks, and then do the same for Jill. One of the trick questions that they may come up with is, what are you allowed to include in retirement assets regarding the employer contribution either to the 401k or to a defined benefit plan? What are you allowed to include? Anybody? Use a texting or give me a voice answer, please. Somebody? I'll repeat the question. If you have money in your 401k plan and some of it is and let's say $100,000 is your money from your deferrals, and $20,000 is from your employer contribution. And thank you, Danielle. And out of the $20,000, $9,000 is what is vested to you, which means you own it. Do not include 100 plus 20, only include 100 plus 9. And the reason I'm saying that is, again, my understanding is on a recent exam, they made sure that they asked and they put up on the statement the vested balance of the employer contribution. If you have a defined benefit plan, again, you can only count the vested balance. Now, part of the reason you can count the vested balance is, if you remember the financial planning process, the last step was to monitor. So if I'm putting together a financial statement or statement of financial position or balance sheet as of December 31st, 2013, and the vested balance as of that date was $9,000, even if the plan went into receivership or had to go to the Pension Benefit Guaranty Corporation or whatever, that was my money. If I lose it all, when I do my next statement, when I'm doing the monitoring, I can always adjust it. The reason I'm bringing that up is one of the textbooks said, don't count it at all. I disagree. Count it for that date in time because that's what they're asking. When they're talking here about insurance, they're talking about the death benefit. They are also talking about possibly the cash value. You may want to list it separately. Education. Are you talking about 529 plans and you're the owner? Are you talking about uniform gift or minors accounts where you don't list them at all because it belongs to the child? So when you're talking about education accounts or special needs accounts or special needs trusts, pay attention to who is the owner, who's the beneficiary, and how it's titled. Pay attention to use assets. Here it's talked as tangible. Your real estate, your collectibles, what you use to maintain your lifestyle. You break it down this way so you'll be able to see it. And I hope what I'm doing here is helpful because I'm not sure everybody's following me. What are liabilities? Remember to pay attention to current liabilities or short-term liabilities that says they can be paid within 12 months. Long-term liabilities where you're going to be paying things over a period of time. Well, a car loan that's 60 months out is a long-term liability. The car loan in the last year is a current liability. I'm in the midst of paying off a interest rate free consumer loan, I'm down to the last 4 payments. That's a current liability. As a matter of fact, the only reason I haven't paid it off is it's interest free, and I'm getting to the point where it really didn't matter. I just didn't want to come up with the cash, and no matter how I did the math, it was a tax-free. It was an interest-free loan, so I just decided to pay it each month, and that's where a lot of people are, and that's something that people are using right now. One of the big issues you may come across is telling people about paying down their credit card balances, especially if they're at 12, 14, 18, or higher percentage rate. Long-term debt, again, those are going to be the longer terms like mortgages, student loans, home equity lines of credit. Pay attention to what's fair market value. Does anybody remember what fair market value is in the first class? Anybody? Okay, I'll give you some help. It's what a seller will accept from a motivated buyer, and someone not in distress, but what are you willing to accept? Sometimes you have to figure out what fair market value means. Sometimes it's pretty simple. If you're buying a stock or a bond, you can get that 24 hours a day just about. If you're talking about collectibles, antiques, or the real estate value, you may have to figure it out. Now, in the textbook, and I'm not going to go through all of these slides, in the textbook there are a whole slew of commonly used financial ratios that might be used as part of your calculations for your case study, as well as part of the calculations for the exams. Now, monetary assets divided by liabilities. Greater than 1 is good, less than 1 is not. Greater than 1 is good because the emergency fund ratio, the emergency fund is highly tested. The emergency fund might give you questions where they're going to ask about what % you have, or what is the optimal amount that you should have in an emergency fund based upon this situation. I think you just lost my video, but I'm still here speaking. I hope you can hear me. I don't know what's going on with me tonight, because I know I have I'm not doing this wireless. I have a hard wire into my computer. The emergency fund. Do you have enough money in liquid cash? Liquid cash, that's savings accounts, money market accounts, the money in your checkbook over and above your current needed bills. Do you have enough money there to fund 3 to 6 months of living expenses? Now, understand, if you have a 1-income wage earner, the optimal amount is probably going to be 6 months. If you have a family where you have a lot of accounts receivable because they're professionals and they have 90 days receivable, the optimal amount might be 3 months. So read the savings ratio. The savings ratio, the higher the better, but also remember that if you're starting out at age 50 to start saving money for retirement, you better be putting away more than 10% if that's where you're starting. What about your long-term debt ratio? There's another slide, consumer payments. Now, let me go through a couple things here because it's highly tested. The front-end mortgage calculation. Sometimes they break it down as front-end and back-end. Currently, the test is recording for principal, interest, taxes, and insurance is annual payment divided by gross income of 28% or less. So if it's at 28%, that's fine. If it's at 29%, it's not good. It's recording your total payments for car loans, student loans, and so forth at 36%. January 1st, 2014, the law changed a little bit, where now that 36% can be as high as 43%. To the best of my knowledge, ladies and gentlemen, they're still testing at the numbers in the textbook and on this slide. However, if you're taking the exam and you take a review class, ask them what number they're using. If they're using 43%, big difference. Let me give you an example. There was a question that asked, what is the current front-end ratio? And on the test question, based upon the income, it was 24%. They were within the limit. Under the new regulation, the income could go down to $57,000 and still be within the limit, where the income started nearly $200,000 to begin with. So you have to figure out what that ratio is. Oh, I'm sorry, maybe that income was about 140, but you have to pay attention. Now, the next slide, and again, this is all in your textbook, is going through each additional ratio. For the emergency fund ratio, the optimal amount is 3 to 6 months of fixed and needed living expenses. Now, the last couple exams that I have found out and been able to see these test questions did specifically go and ask about the optimal amount using a scenario. So it's going to be your living expenses, and you have to figure it out. In the textbook, it talks about 3 or 4 different ratios. You're probably not going to be asked more than what I told you, 3 to 6 months. So you might also want to take 5 minutes and figure out, with having 6 months of your income or your living expenses, how we want to phrase it, what does that mean? Well, figure out, is that 6/12? Is that 1/2? You better figure out the number just so you have it in advance. The next 7 or 8 slides give you different ratios, but I'm going to go to these 2 mortgage ratios because that's 2 that they tend to test on a lot. Okay? It says right in the middle, there are 2 debt limit ratios that are widely used. First, the 28% rule, which I just explained, which is principal, interest, taxes, and insurance. Be aware of the fact, ladies and gentlemen, that if you're going for a mortgage and you're buying a condo, they may even throw in the maintenance or the monthly maintenance fee because that's a fixed expense. But unless they identify you're buying a condo and list it as one of the things to look at, don't worry about it. The second debt ratio is the repayment ratio. That's at 36%. That's the one that they've expanded now to 43%, but I don't know which one they're going to use for your exam. Under the new regulations for ARMs, which are, adjustable rate mortgages, they no longer be using the teaser rate. Under the new regulation, they're going to be using the maximum mortgage rate that they can charge within the next 5 years. That's my understanding of the situation. I'm just looking over my notes a little more so I can make sure I pick everything up for you. When you get a question on refinancing, they may ask a question on refinancing, whether or not you could refinance to a 15-year loan or a 30-year loan. The reason they're going to do that, quite frankly, is to see if you know how to do the math and the ratios, because you might not qualify for a 15-year refinance as opposed to a 30-year, depending on how things are. Now, any questions so far? I deliberately went through this because one of the issues people are having on the case, as well as when they take the exam, is they need more information on the cash flow statements, the statement of financial position. So please review Chapter 3, and I gave you the highlights of which ratios to worry about. You don't have to memorize every ratio. I just gave you a broad paintbrush of what the big ones are.
Nice refresher.
And one of the case studies in the back spends more time on the ratios, so you can
nice
do it
refresher from the material from the first class.
Any questions so far? Has this been helpful? Has this been a waste of your time? I don't know, because I don't know a lot of your backgrounds. So if this has been helpful, let me know. If this is, I'm sorry? I don't know who spoke. Zach, say it again, please. Okay, thank you. What I'm also going to, thank you, Brad, for your text message too, Zach. What I'm also going to try and do is give you a little more refresher on some of the other chapters. I don't want to regurgitate everything, because if I would go through all of the slides, you're going to find we're going to spend 2 to 3 hours each night going through stuff that if you've already taken the classes, just review. I'm just trying to give you highlights. Susan, yes, they should be posted. I'm going to make sure they're under the content sometime tomorrow, if not tomorrow, by Thursday. I need to review a couple other things. Those of you that have not had your individual appointment with me, either over the phone or scheduled one in person, it's your responsibility to do it. I want to make sure I keep you on track. I will give you some flexibility if we need to run a little bit past the deadline for you to get the case study done. I want it done properly. I want it done correctly. And please review the samples that are up there. I had somebody send me a case study last month before the last semester ended, and all they did was cut and paste what we already gave them for the material, and then they only focused on the investment allocation. It is a comprehensive plan. You need to focus on education funding, retirement funding, cash flow statement, estate planning. Do they have enough insurance? What about business succession planning? What about, if you read the Harris case, there's a special needs situation. All this has to be covered. You can't just do one piece of it and say you finished the project. That's why I want you to spend time on it. Any other questions? Anything anyone wants to ask or wants me to make sure I cover next time? You're all a pretty bright group because you don't have any questions. So I obviously answered everything. Was reviewing the Beto case helpful? To at least point out some of the things you should be looking at for the Harris case. That was my intent.
Yes.
Thank you.
The Beto case seems a lot more complex than the Harris case, just from my review.
The Beto case seems more complex than the Harris case?
Correct.
Okay. Reread the Harris case. I promise you the Harris case is really complex, and there's a lot of things you can put together. Be aware of the fact that for the Harris case, you have to defend your position. I'm not saying what's right or what's wrong. You're not going to be graded down if on your investment analysis as long as you can defend it. But I will tell you that the Harris case is more complex than the Beto case. Promise you that.
I guess I meant there's more details around the Beto, like there's more information, I guess.
Okay, I'll buy that. The Beto case was written for a textbook. There is more information, granted. But what we're looking for on the Harris case is much more complicated.
The other question I have, so I use the evaluator, the Excel evaluator provided by the book. Are we allowed to use that on the Harris case?
Yes.
Okay.
You are allowed to use that on the Harris case. I'm also going to tell you something else. I'm going to double check. I'm going to have a sample engagement letter posted. I'm going to try, and I'm not going to ask you to go and spend hours and hours writing an ADV part 1 or part 2 or whatever, because if you're with a broker-dealer or a registered investment advisor, they have probably spent thousands of dollars putting together an ADV. But I am going to tell you, better understand it, because I have a right to ask a question on it when you're presenting your case. I also will tell you that if you are an investment advisor representative and you already have an ADV Part 2B, you can add it to your case and I'll accept it, because in the real world you need to have presented that. The letter of engagement, the ADV, is technically stuff you should have given to the client in advance of the case, but since we're doing this as a project, you have to do it together. I don't care if you don't have 15 different graphs and charts, but you better have at least one. One person one semester said this should be your new asset allocation, but never explained what the old asset allocation was. Well, I had a hard time accepting it because I didn't know where I was going. But he said, well, this is where you should be. And I said, well, how did you arrive at this? And you would have thought I was talking Greek. So again, you have to be able to defend your position. It's not just a question of what's right or what's wrong. So if you happen to think the person should be more aggressive, fine. If you happen to think they should be less aggressive, fine. Just to be able to defend it. And again, I'm not looking for 12 different pages of graphs and charts, but at least one or two. You can use the thing that's in the textbook as the Excel facilitator. That's why it's there. Anything else? You're asking good questions tonight. Thank you. Hello? Okay, I'm going to go around the horn. Zach, do you have any other questions? Or anything you need me to cover, or anything you want me to cover next time?
No, we're all good over here.
Okay. If you have any questions in the interim, email them, and I will probably respond to you and everybody else. Danielle, what about you?
I have no questions at this time.
Okay, Brad? Okay, no questions. Susan, you okay? Okay, good. Now, the other thing is, because it's an online class, there's one more discussion assignment I want you to go and do. Here's it's up there. The question is, you are the client. I don't want esoteric things talking about as a planner or with your 20 years of experience. If you're the client sitting in the chair and I'm asking you the question is, what is it about money that's important to you? And there's no right answer. You can't flunk it. But once you ask the question, the assignment is each of you have to go back and answer 3 people. So you have to have at least 3 answers to different people as they answer the question. And I'm going to be checking it. I want it completed within the next 2 weeks so that you've done your discussion, introducing yourself online, you will have done this, and that'll take care of the online requirement. And it's an important question because it's helping you ask open-ended questions to get to know more about the client. So when you're doing, in the real world, a fact finder or your idea of what's going on, you know where you're going. So that's the purpose of the assignment. It's not to say, well, as a planner, money means this, this, and this, and you have to. What does it mean to you? Having money, what does it mean in terms of your stress level? What does it mean in terms of your enjoyment, in terms of your life? What does it help you do? And each of you should have different viewpoints. Based upon some of the comments I've seen on your bios, each of you will have different viewpoints, and that's what we're getting at. Everybody understand that? I'm going to take that as a yes. I'm going to stay in the classroom. I can go another hour, but I think you're probably tired. I want you to spend the time doing your homework. You'll get your comments by Friday. I am free. I'm easy to reach via email and or my phone, voicemail, and I will respond to the best of my ability within 24 hours. So have a good week. We're not going to meet next week, but I'm going to post some things online and make sure that some more of these slides are in the content area so you can see them. Okay? Thanks very much. I'll be in the classroom in case anybody wants to talk to me. I'm stopping the recording.